This class will be concerned with external diversification. External diversification occurs when a firm looks outside of its current operations and buys access to new products or markets. So the company is looking outside of what it traditionally does. It's looking at other companies and diversifies into other markets. It acquires the other companies and thereby giving it a foothold in other markets. Mergers are one common form of external diversification. A merger is when two similar companies, join together. They agree to merge and become a single company. So mergers are quite common, and that's quite a common form of external diversification. Even though two companies are similar, they may not be exactly the same. They may have slightly different products, or they may have variations on a single product, so that it is a form of diversification. So mergers is a way of growing the company and also including the opportunity for the managers and for the shareholders, the opportunity to widen the type of products they're delivering onto the market. So mergers occur when two or more firms combine operations to form one corporation. Perhaps the new company could have a new name. It may, however, retain one of the names of the merging companies, particularly if that name is well placed in the market, has a good reputation, it's strongly branded, and perhaps it's an old company and well respected. But it all depends. Sometimes the merged company may have a new name. The companies, generally speaking, are similar size. You don't get a merger between a very small company and a very large company. We don't think of it in those terms. We normally think of the companies being roughly the same size and they merge. They come together to form one bigger company. One goal of a merger is to achieve management synergy by creating a stronger management team. The idea is that with the two companies there are two sets of managers, and they each have expertise and knowledge of the market and also knowledge of their products. But when the companies come together, all of that expertise is available to the single company. Now it may mean some of the managers are no longer required, but it does mean that the pool of knowledge that the new company can draw on is much larger. So there will be better understanding of the market, of customer requirements, of products. The management will have much more information upon which to work. So that is a synergy. That is a real benefit to the new company. And management costs should of course fall as well, because as I said, not all of the management perhaps will be required under the new structure. This can be achieved in a merger by combining the management teams from the managed firms. So the new company simply merges the management teams and then looks at the configuration of the management teams to see where the strengths are, where the weaknesses are, and who's required and who's not required. But it's a much more effective management team. At least that's the way it's generally considered. That will be the attributes of external diversification of mergers. Now it's also possible to have internal diversification. Acquisitions is a second form of external growth, and it occurs when the purchased corporation loses its identity. Now, an acquisition means one company taking over a second company. The company that's taken over loses its identity. So the acquiring company absorbs the other company. The other company ceases to exist. It becomes part of the company that took it over. The acquired company and its assets may be absorbed into an existing business unit or remain intact as an independent subsidiary within the parent company. So, one way or the other, the company ceases to exist. Either it's absorbed totally, all the assets are taken into the other company, and all of the facilities, the productive facilities, the management, all of the expertise, the core competencies, everything it had are absorbed. Or alternatively, it's just kept as a subsidiary of the other company, run as a subsidiary and controlled as a subsidiary. So acquisitions usually occur when a larger company takes over a smaller company. It acquires the smaller company. Although there are examples of small companies acquiring larger companies, sometimes it happens, and it's possible to read about these in the financial press. It's rare, but it has happened. Acquisitions are called friendly if the firm being purchased is receptive to the acquisition. So it's a friendly acquisition if the firm that's been acquired does not resist it. That's a friendly acquisition. So it's acquiring the business, but the business that's been acquired agrees. They're happy to be taken over in this way. Mergers are usually friendly. Mergers are two companies coming together, two or more companies coming together, and that's usually friendly. That's usually agreed between them. Unfriendly mergers or hostile takeovers occur when the management of the firm targeted for acquisition resists being purchased. Now, if the company being taken over resists it, it doesn't want to be taken over, that's an unfriendly approach. Now, these are some ideas about internal and external diversification. And this is all I want to do in this session, is to talk about essentially mergers and acquisitions and look at those as a form of corporate growth. So I'm going to leave it at that for the moment and say thank you for watching.